All right, today we're diving into Public Square's latest earnings report, and this one is a fascinating story. On the surface, you've got some numbers that look good and some that look, well, not so good. But the real headline here, the thing that really matters, is a massive company-altering pivot that management just announced. So yeah, let's get right into it.
So this is the central mystery we need to solve. How on earth does a company post an earnings number that blows past expectations, only to see its stock get absolutely crushed? It doesn't make sense at first glance, right? To figure this out, you've got to look at the two conflicting headlines that really define this report.
Okay, here's the tale of two numbers. On one side, you have this really strong earnings beat. They lost less money than anyone thought they would. 33% better than expected, in fact. And that usually signals that a company is managing its costs really well. But, and this is a huge but, on the other side, you've got revenue. And it was a big miss. They came in 21% below what analysts were forecasting. So a great bottom line, a terrible top line. You can see why the market got so confused.
In this number right here, this tells you exactly how the market decided to feel about that confusion. The stock dropped like a rock, down almost 15% in the single trading day after the call. So the verdict was in, and it was brutal. Clearly, investors decided the bad news was way more important than the good news.
So what was so bad that it overshadowed a 33% earnings beat? It was this: the great FinTech pivot. Management got on the call and essentially announced that they are tearing up the old business plan and starting fresh. This strategic shift is the key to everything. The numbers for this quarter were almost an afterthought compared to this announcement.
And I'm not exaggerating when I say this is a massive change. You know, the old Public Square was trying to be three things at once: a marketplace, a consumer brands company, and a FinTech platform. Now, they're basically throwing 2/3 of that identity away to go all in on becoming a pure-play FinTech company. It's a huge bet on a single vision.
And they're not messing around. They're moving fast. The plan is to sell off their EveryLife consumer brand completely. Then, they'll either sell or find a new use for the technology behind their marketplace. And the deadline for all of this? The end of Q4 this year. They want to start 2026 with a totally clean slate, focused only on FinTech.
So you might be wondering how they do this from an accounting perspective. Well, they use something called discontinued operations. It's a standard practice, and it basically lets them take the parts of the business they're selling and report them separately. The reason this is so important is that it gives investors and us what they call cleaner optics. It lets everyone see exactly how the core FinTech business is performing on its own without all the noise.
But here's the catch. This is the real reason the stock got hammered. When you're selling off huge chunks of your company that were bringing in revenue, it's pretty much impossible to forecast what your total sales will be. So management did the only thing they could do. They completely pulled their revenue guidance for the rest of the year. And if there's one thing the market absolutely hates, it's uncertainty. This move just shrouded the company's immediate future in fog.
So, if they're tearing down the old model, what are they building in its place? Well, the new vision for Public Square is laser-focused on three high-growth areas: artificial intelligence, cryptocurrency, and next-generation payment services.
And they've already got some really compelling proof that this can work, especially on the AI front. They've been training machine learning models since 2021 to help with their lending business. The result? They've slashed first payment defaults by almost 75%. That is not a small number. That's a real game changer that makes their lending business fundamentally more profitable.
And to show just how serious they are about crypto, they've made a powerhouse addition to their board. They brought on Caitlin Long. Now, if you follow the digital asset space, you know that name. She is one of the most respected experts on crypto finance and regulation out there. This is a massive signal that they plan to build a serious, compliant crypto business.
And the new FinTech engine is already starting to fire up. Their payments business alone grew over 80% just in the last quarter. That's incredible growth. They're also chasing down these things called money transmitter licenses, which will basically let them keep more profit from each transaction. On top of that, they're building out what they're calling cancel-proof crypto infrastructure and a bundled checkout product that's already in high demand. This is the future of the company, right here.
Okay, that was a lot. We've gone through the messy earnings, the huge pivot, and the new vision for the future. So now let's put on our analyst hats and try to make sense of it all. What does this mean for the stock, and what should we be looking for on the next earnings call?
And of course, before we get into our take, the very important disclaimer: this is not financial advice. All right, let's break down the key milestones coming up that could really move the stock. The next 6 months are going to be absolutely critical. First,
In the third quarter report, we'll see those old assets officially move to discontinued operations. That's our first clean look at the new FinTech business. Then in September, you're going to want to circle the date for their Analyst Day. That's when they've promised to lay out the whole FinTech and crypto roadmap. And finally, by the end of the year, we should get confirmation that the asset sales are complete.
So really, you can now see two very clear competing stories for this stock. The bulls are excited. They see a leaner, higher-margin fintech company about to emerge, armed with powerful AI and a big crypto opportunity. But the bears are waving a red flag, pointing out that the company just pulled its guidance, is going through a really risky transformation, and the stock has been a terrible performer. And you know what? Both sides have a pretty strong argument. So this all leads us to our final thesis. Right now, Public Square is the textbook definition of a high-risk, high-reward turnaround play. The potential upside is massive if they pull this off, but the number one risk is all about execution. Can they actually do it? Because of that huge question mark, our rating is market perform. It's a wait-and-see story. The uncertainty is just too high to be more aggressive right now.
And that really is the final billion-dollar question. Public Square has pushed all of its chips into the center of the table on fintech. Is this the bold pivot that finally unlocks massive value for shareholders? Or is the risk of trying to pull off such a complex reinvention simply too high to handle? It's going to be fascinating to watch. And one last time, this is not financial advice.